everyone. Welcome to Hand Rolled Real Estate. I'm Robbie. I'm here with Jay today, and we're mixing it up a little bit today. We're smoking different cigars, but nonetheless, we're still really excited and we're ready to talk about real estate and smoke cigars while we're doing it. Today, we're going to talk about depreciation and what that means and what it means to your pocketbook.
Yeah, I'm Junaid. Welcome to Hand Rolled Real Estate. I am smoking a Punch Rare Corojo. These cigars are we want to thank Jason Wright and his group Smoke, Flow, and Grow. Jason's got a really cool group that he sends care packages out every quarter with cigars and coffee and books. And then we get together once a month on a Zoom call. We smoke a cigar and we talk about business and we talk about how to grow our business. And it's kind of like a mastermind group. So, we'll link to Smoke, Flow, and Grow. And again, Jason, thank you for sending me this Punch Rare Corojo and Robbie's God of Fire series. Is that Series B?
Series B. Thank you, Jason. This thing's amazing.
So when it comes to depreciation, a lot of people want to know what is depreciation and how does it work and how does it work for me. Basically, depreciation is the economic deterioration of an asset, not necessarily the physical deterioration. So basically, the IRS and accounting rules both say that if you have an asset in place, over time, it's going to have wear and tear on it and it's going to need to be replaced. And so, what the accounting rules under generally accepted accounting principle and the IRS rules under tax depreciation, which are two separate sets of rules, give you an amount that you can reduce your income by as an expense, a depreciation expense. You can reduce your income by that amount every year, depending on the asset, for the wear and tear of the current asset.
Who gets to decide and how do they decide the useful lifespan of an asset? And does it vary by class?
It does. For tax purposes, the IRS gives you tables. For accounting purposes, generally accepted accounting principles, which is GAAP, gives you tables as well. GAAP makes it a little bit easier. They have straight line depreciation and different types of accelerated depreciation. But for our purposes, we want to focus on tax depreciation because that's what affects our bottom line as far as how much of a deduction we get and how much we pay in taxes. So the IRS has tables. The IRS has classifications of different categories and they will tell us how much you can depreciate. So, for example, there's 3-year property, there's 5-year property, there's 7-year property. Real estate in general is 27.5 years. So 27 and a half years is how it needs to be depreciated.
And in some cases, you hear them talk about accelerated depreciation. And what are some of the situations that allow you to accelerate the depreciation?
So accelerated depreciation was introduced in the 2017 Tax Cut and Jobs Act. And basically, what that allows you to do is to, instead of depreciating your property over 27 years, 27 and a half years, or 39 years, right? So there's two separate categories, but mainly for multifamily and real estate that we're in, 27 and a half years. So instead of depreciating your property over 27 and a half years, you can accelerate all of the depreciation within the first year. Um, the thing of that bonus depreciation is that it's really good if you have income that is passive and you have other passive income. You can net the bonus depreciation from one property against the income of another property, net it out and zero it out. So it depends on your particular case, and I would really recommend you talk to your CPA, your tax advisor, because every case is different. And you may not want to take bonus depreciation, all of it in the first year. You may want to have it divided over a few years, depending on how your income is.
So even if it is eligible for accelerated depreciation, you don't necessarily have to take it in that first year if you choose to, to depreciate it over time.
Correct. You don't have to take it. You can opt to take it over 27 and a half years. The other thing with the accelerated depreciation or bonus depreciation is that uh, it was good up until 2022. You could take 100% depreciation the year you purchased the asset, and then it's going to start getting phased out after that. So in 2023, any assets placed into that purchased in 2023 are only 80% accelerated, and then 2024 is 60%, and it gets phased out. So 10% down every year almost, and then it gets phased out by 2027. There will be no more accelerated depreciation. We go back to 27 and a half years.
Well, obviously, there's going to be some timing issues, and if you were going to accelerate your depreciation, it would clearly be to offset income from another property or some other form of income.
Correct. So the 1986 Tax Act under Ronald Reagan, before that, you could use your losses from property against your W 2 income. You could use your losses from stocks. Any stocks that were losing money, you could sell them and then use those losses against your W 2 income. The 86 Tax Act changed all of that. And what essentially happened was that the IRS created three separate buckets: ordinary income, which is your active income, passive income, and portfolio income. So they created three separate buckets, and you can't necessarily net the losses against the gains of any other bucket, but there are some exceptions. So when we say active income, we mean anything that you materially participate in, you know, W-2, when you go to your job, you get a W-2, that's active income. And active income, everybody knows, is subject to FICA, Medicare, and your state. Passive income is anything where you don't materially participate in it. Real estate is always passive by law and by tax law. And but if you don't materially participate in it, you are a limited partner. That is passive income. And then portfolio income is anything that comes from your stocks. And if it's bought or sold within the first year, then that's taxed at the ordinary income rates as active. And if you hold it for 1 year and 1 day, then it's passive.
In regards to the depreciation for the passive investor and the W-2 earners, it's a little bit more clear cut. But when you get into real estate professionals, it seems like it's a little bit more clouded. What do you think? Is there some clarity there? Is there some rules or guidelines that these real estate professionals should follow?
Yeah, so in order to deduct depreciation, there's actually three categories. There's the passive investor, and the passive investor can net uh, profits and losses from passive activities. So let's say you had one real estate activity where you made $100,000, and then you have one real estate activity where you lost $100,000, and you're a passive investor in both. So you can net those two out and have zero income, and you don't have to, and there's no taxes on that. But if you don't have passive, uh, if you don't have passive income, and let's say you have a passive loss of $10,000, for example, you can't use that loss. You can only use $3,000 against your active income, which is your W 2 income, and then you'll have to carry the $7,000 forward and then use it the following year. So you can't you can use $3,000 of that passive loss against your active loss.
But if it's passive to passive and you can't exceed your loss or your depreciation can't exceed your income.
Correct. You can only net it out. You can only bring it down to zero.
But you can move it forward to future earnings.
You can move it forward to future earnings. That is correct. You can net it out to zero. You can move any unused losses to future earnings, passive to passive. Passive to active, you can only use $3,000 every year, and that indexes with inflation. And from time to time, the IRS will say, okay, you can use $3,500 as of this year. Um, and then you move the rest forward to the subsequent years. So that is if you are just a passive investor. Another category is an active investor, and there's no special election that's required for active investors. Basically, you have to actively be involved in managing properties. So let's say you have a W 2 job, but you have three or four houses that you actively manage, right? You you go ahead and you get the make readies done. You call the contractors to get things done, things fixed in the house. You go, you collect the rents, you do the accounting. When tenants move out, you find new tenants. You do all that stuff. Well, now you're an active real estate investor, and as an active real estate investor, you can use up to $25,000 of depreciation expense against your W 2 income. But that starts getting phased out once you hit $150,000 in an adjusted gross income. Um, it starts getting phased out.
So, as an active investor, you can, again, the same rule applies where you can depreciate money based on your income. However, if you don't have any income, you're limited to 25,000 on your AGI, up to 150,000.
So if you have W 2 income, right? So as an active investor, you could take your depreciation from your passive properties and you could deduct up to $25,000 against your W 2 income. Okay? So it doesn't have to be passive to passive. Now you're deducting against your active, but it phases out, right? So $150,000 if you're married, $100,000 if you're single. If you start making more money than that, then that $25,000 starts decreasing and any unused losses can be carried forward. The third category is the real estate professional. As a real estate professional, as long as you're spending 750 hours minimum and over 50% of your time in real estate activities. So, if you're a realtor, if you're a developer, if you are, doing anything where you're, like what you do, go look acquisition of land and things like that, you're a real estate professional. You don't have to have a real estate license. I guess it's good if you do, but then it's not just having the license, right? It's putting the time into it. With that designation, you can deduct a lot more of your depreciation against your ordinary income. How much depends on how much you're making and depends on your tax status. So I suggest people talk to their CPAs and ask them about the real estate professional designation if you are in that category.
Yeah, I mean, depreciation can really, it can really help offset a big sale, any kind of big income in real estate. And the depreciation can be invaluable, and timing's so important to all that. And I know there's some real estate professionals out there that have mastered the timing. I've yet to master the timing, but it seems like it's a really crucial piece of the pie.
Yes, and people should also understand that there are other things that you could do in order to reduce your taxable income. For example, the 1031 exchange, and there's a 1031 exchange which, you know, when you have depreciated an asset, uh, as long as you buy another asset that is the same price or more than the asset that you're selling, you can just roll over your gains into the next property, and you won't have to pay. But you won't have to pay any taxes. But that's something that on a different episode we can talk about 1031 exchanges and depreciation recapture, which is another very important topic because people sometimes don't understand that when you depreciate a property and you don't 1031 exchange it and you sell it, all that depreciation gets recaptured and gets added back to the basis of the property so that your gains are higher.
Yeah, like just like Jay said, reach out to your tax professionals. As you start making more and more money, and you keep investing in real estate. I mean, depreciation can be a really good, useful tool to help reduce your taxable income. Um, Jason, thanks again for this God of Fire Series B. It's amazing. Um, Hit us up on all our social medias. Leave us questions, comments. We'd love to hear from you guys.
Thank you, everybody. And again, Jason Wright from Smoke, Flow, and Grow. We will put a link to his group, his mastermind group, where you can smoke cigars and talk about business and learn from people. We will link in at the bottom of this episode. And thank you again, Jason Wright. Have a great day and get yourself.